The silver market saw sharp movement as prices briefly reached a new all-time high near 8,267 before retreating within minutes. The sudden reversal quickly triggered widespread headlines using the word crash, a term that appeared almost immediately after the pullback began. The move followed a rapid upward surge, and the decline that followed amounted to only a few dollars, representing a retracement of less than 5% from the peak. The price action occurred after silver had climbed sharply in a short period of time, marking a record level before easing back. The pullback took place shortly after the new high was recorded, following what had been a strong upward run. The decline was limited in scale and did not approach a drop of $30 or anything close to a major percentage loss. The movement reflected a pause after a steep climb rather than an extended downward move. Despite that, the immediate narrative surrounding the price action focused on alarm, framing the retracement as a breakdown rather than a routine market response following a rapid ascent. The timing of the reaction drew attention. The language used to describe the move did not emerge when silver traded at lower levels such as 50 or 60, nor during the days when prices were advancing steadily. Instead, the intensified focus began only after silver reached a new record, suggesting that the reaction coincided precisely with the moment the previous bearish expectations were invalidated by price performance. The retracement followed the breakout, a sequence that often occurs after strong upward momentum. According to the details presented, the price movement itself was limited. Silver printed a new record high and then pulled back by less than 5%. That sequence marked a brief cooling period after a rapid climb, rather than evidence of a broader market reversal. The decline followed a vertical price move, during which prices had advanced quickly over a short period. Such pauses are commonly observed after sharp rallies, as markets temporarily stabilize following accelerated gains. Attention also turned to developments in China, which became a focal point of the broader discussion. A silver-linked investment vehicle listed in China experienced a limit-down trading session, falling 10% and triggering trading restrictions. The structure of Chinese markets includes daily price limits and circuit breakers designed to halt trading when price movements exceed predefined thresholds. When those limits are reached, trading is paused automatically, regardless of broader market conditions. The trading halt occurred after the product had already risen significantly. Prior to the limit-down session, the vehicle had been trading at a substantial premium relative to the underlying silver exposure it was designed to track. At its peak, that premium exceeded 50%. This meant investors were paying far more than the implied value of the silver exposure itself in order to gain access through that product. The premium reflected intense demand for exposure rather than a direct assessment of silver's intrinsic value. Following the limit-down move, trading restrictions were implemented, and the premium began to compress. This compression occurred as part of the exchange's structural mechanisms rather than as a direct judgment on the silver market itself. Premium fluctuations reflected changes in access and demand rather than changes in the quantity of silver available. The pause served as a pressure release function built into the exchange's rules, activating when price moves become extreme over a short time frame. The management of the investment vehicle also adjusted subscription activity as inflows accelerated. Restrictions on new subscriptions were applied as demand outpaced the ability to expand exposure efficiently. This action reflected operational limitations rather than a statement on silver's underlying strength or weakness. Subscription limits were implemented due to capacity constraints in sourcing exposure, not because of a change in outlook on the metal itself. The situation highlighted the distinction between paper pricing and physical availability. Screen prices reflected futures and paper contracts, while real-world transactions showed higher costs in certain channels. Premiums represented the gap between quoted prices and the amounts buyers were willing to pay to secure exposure. This divergence underscored differences between financial instruments and physical market conditions, where availability and delivery timelines play a role. Physical silver is consumed across multiple industries and is not simply stored indefinitely. It is used in manufacturing processes, including electronics and other applications where recovery is limited. This ongoing consumption affects availability over time. As demand rises and access tightens, discrepancies between quoted prices and physical market conditions can become more visible. As markets move through this period of volatility, attention remained focused on the interaction between rapid price gains, subsequent pullbacks, and structural mechanisms within global exchanges. The events surrounding silver's record high, the brief retracement, and the developments in Chinese trading venues set the stage for continued scrutiny of supply conditions, demand intensity, and market structure. As the market reaction continued to unfold, attention shifted toward how price movements were being explained across Western financial coverage. One commonly cited explanation was that traders were locking in profits ahead of scheduled economic data, including an upcoming employment report. While some participants did reduce positions, the activity was matched by buyers on the other side of each transaction. Every contract sold was absorbed by another party, meaning the volume reflected an exchange of positions rather than a one-sided exit. The presence of buyers during the pullback indicated continued participation rather than a lack of interest. The focus, according to the article, should not rest solely on who sold, but also on who was willing to buy during the decline. Different types of buyers imply different market conditions. Retail-driven buying can suggest short-term momentum, while institutional or industrial participation points to longer-term structural demand. The article states that indicators observed during this period aligned more closely with sustained demand rather than speculative excess. The discussion then turned to expectations surrounding monetary policy narratives linked to the upcoming jobs report. According to the article, market commentary often frames strong employment data as a reason for higher interest rates, which is then cited as a negative factor for metals. Conversely, weaker data is often portrayed as a signal of economic slowdown, prompting broad selling. The article emphasizes that these explanations are frequently reused regardless of the outcome, with similar selling pressure attributed to different justifications. The article notes that a single data release can influence short-term expectations, but it does not erase broader monetary conditions that have developed over an extended period. Structural financial pressures, including accumulated obligations and rising interest costs, remain present regardless of individual reports. These broader dynamics influence policy direction over time rather than shifting based on one data point. Silver's role was also described as extending beyond monetary considerations. The article emphasized that silver functions as both a financial asset and an industrial material. It is used in applications such as power systems, electronics, medical equipment, and defense-related technologies. This dual role means that silver demand is influenced not only by financial conditions, but also by ongoing industrial requirements, which do not fluctuate based on short-term economic releases. Geopolitical factors were also referenced as part of the broader environment. According to the article, global trade systems have become more fragmented, with export controls and strategic material policies re-emerging. Certain materials are increasingly treated as strategic assets rather than purely commercial commodities. When restrictions are introduced, supply chains face increased pressure, leading to bottlenecks rather than smoother distribution. The article stated that supply chain disruptions tend to develop rapidly rather than gradually. When access to key inputs becomes constrained, buyers may be forced to secure materials at higher costs to maintain operations. These conditions can intensify demand pressures and affect pricing dynamics, particularly for materials with limited substitutes. Returning to the recent pullback, the article described it as a period that tests market participation rather than signaling an end to demand. It reiterated the distinction between observable facts and interpretations. The documented facts included a price pullback following a record high, a Chinese silver-linked product hitting a downlimit trading session with subscription restrictions, elevated premiums in certain channels, and finite physical availability. Interpretations presented in the article framed these developments as part of a volatility-driven process rather than a fundamental breakdown. Psychological factors were also discussed in the context of market behavior. According to the article, sharp declines following rapid gains often draw disproportionate attention, causing participants to focus on short term price movements while overlooking the broader trend that preceded them. Language such as bubble or collapse was described as influencing sentiment by encouraging caution or withdrawal during periods of volatility. The article used structural comparisons to describe how markets behave under pressure, noting that price cooling after rapid increases reflects stabilization rather than failure. It emphasized that silver's demand is supported by multiple drivers, including financial considerations and industrial consumption. Unlike assets with a single source of demand, silver's usage spans multiple sectors, contributing to sustained interest. The relationship between gold and silver was also addressed. While ratios between the two metals are often monitored, the article noted that such metrics reflect historical patterns rather than guarantees. During periods of strong metals performance, silver has historically outpaced gold at times, but the article cautioned against relying solely on ratios without considering underlying conditions. A recurring theme in the article was the difference between paper markets and physical supply. Financial contracts can be created rapidly, while physical silver requires extraction, refining, transportation, and delivery. When pricing on screens diverges from real-world availability, it can indicate underlying strain within the supply chain. Elevated premiums in constrained products were presented as evidence of access limitations rather than surplus. The article concluded by emphasizing disciplined observation rather than reaction. Volatility, particularly in silver, was described as a known characteristic of the market. Tracking physical premiums, inventory levels, industrial demand signals, and policy developments was presented as more informative than reacting to short-term headlines. According to the article, changes in fundamental conditions would first appear through easing premiums, improving availability, and rebuilding inventories. In closing, the article stated that the recent pullback occurred without changes to key underlying conditions. Mining output had not suddenly increased, industrial demand had not disappeared, and broader fiscal pressures remained in place. The price movement reflected market mechanics and narrative shifts rather than a reversal of the factors that had driven silver higher. The segment ended by noting that while volatility may continue, the underlying signals described remained intact at the time covered by the article.